Betting line movement. A number opens at Chiefs -6 and closes at -7.5. Something happened in between, and the explanation nearly every betting page gives for what it was is wrong. The familiar story runs like this. A book watches money pile onto one side, then shifts the number to pull action back the other way and even out its exposure. It's tidy, it gets repeated in broadcast segments and beginner guides alike, and the best evidence contradicts it. Next, the explanation everyone repeats. Stephen Levitt, an economist at the University of Chicago, published the check in the Economic Journal in 2004. He had something nobody studying betting markets had managed to get hold of before. Not just the prices, but the quantities. 19,770 wagers, placed by 285 bettors, across 242 games of the 2001 NFL season. The balancing story makes a prediction. Steer toward an even split, and the money should land near 50-50 most weeks. Levitt found favorites taking 60.6% of the wagers. In almost half the games, at least 2/3 of the action sat on one team. That is a long way from even. A book working to balance would have been failing constantly, in public, all season. Next, pricing into the tilt. So why hold a lopsided position? Because the book forecasts better than its customers do, which makes an unbalanced position one worth keeping. Levitt worked out what that's worth. At the standard price of risking 110 to win 100, a book whose bettors win half their bets has a gross profit rate of 5%. Set the number so bettors win 49.45% instead, which is what his model says the posted prices actually produce, and that rate goes to 6.16%. A distortion of half a percentage point in the win rate. 23% more gross profit. Measured across the whole sample, pricing into the tilt rather than against it lifted margins by 20 to 30% over a balancing policy, which leaves a moving number carrying two things at once. Some of it is what the book now thinks. Some of it is what the customers have done. From a screen, the two cannot be pulled apart. News moves lines as well, and injury and weather adjustments are the one part of the standard account that survives intact. Next, reverse line movement. Tickets run 75% on the Chiefs. The number slides from -6 to -4.5, so the crowd side is getting cheaper instead of more expensive. Sharp money on the other side is the usual reading, fewer bets carrying more dollars. Notice what that reading is, though. It's an inference stacked on top of two observations, a ticket count and a price. The book's own forecast explains the same picture, and needs no professional bettors in it at all. Under Levitt's model, a number drifting against the ticket count is precisely what a book with a better forecast and no interest in balance would produce. One published study has tested the idea head-on. James Francisco and Evan Moore, writing in the Journal of Economics and Finance in 2019, took every college football game carrying a total from September 2005 through January 2016, and asked whether following reverse line movement, in an effort to track professional money, paid. In general, it didn't. The caveats are real. That's a totals market in college football, a long way from NFL spreads, and one paper settles nothing by itself. What it does establish is that somebody checked, and the check came back empty, which is more than the confident version of this claim ever mentions. Meanwhile, the figure circulating on betting sites is that reverse line movement wins 52 to 55%, offered with no named study attached to it. Run the bottom of that range. At -110, a 52% cover rate returns negative 0.73% per unit staked. Half the quoted range describes a loss. Next, 2 sports, 2 answers. Whether the closing number beats the opening number has been examined in 2 sports, with 2 different answers, and almost nobody writing about line movement mentions the split. Basketball first. Gandar, Dare, Brown, and Zuber reported in the Journal of Finance in 1998 that line changes between the open and the close improve the accuracy of NBA betting lines as forecasts of game outcomes. The size of the individual changes tracked the size of the biases sitting in the opening number, and the changes ran large enough to remove those biases by the close. They read that as evidence that informed traders influence the market. Then football. Greg Salkowski and Michael Nelson examined 2,560 NFL games from 2002 through 2011. Their paper set out to test what it called the collective intelligence of NFL fans, as expressed through the betting line. They found the opening line producing a smaller mean-squared error than the closing line, with the gap small and statistically insignificant. So the defensible statement is that the close was not better. It was certainly not the collective wisdom that betting writing credits it with. Next, the overshoot. Tobias Moskowitz published the most useful recent work on this in the Journal of Finance in 2021, drawing on more than 100,000 betting contracts across the NBA, the NFL, Major League Baseball, and the NHL, spanning 3 decades. His framing explains why betting markets are worth studying at all. These contracts carry no systematic risk, and their final prices don't depend on betting activity, which sidesteps the joint hypothesis problem and lets mispricing actually be identified. What he found was strong evidence of momentum, consistent with delayed overreaction, and inconsistent with both underreaction and rational pricing. Prices that move keep moving. The movement from open to close is then fully reversed by the game outcome. The returns are a fraction of what the same patterns generate in financial markets, and they fail to cover transaction costs, which is exactly why the pattern is still sitting there in plain view. Nobody can arbitrage away an effect that doesn't clear the vig, so it persists, visible and useless. Next, steam and timing. A steam move is several books shifting the same number in the same direction within minutes. What can be inferred from one is narrower than what gets claimed for it. The books moved together and moved fast. Whether a syndicate caused it, or a shared data feed did, or one book simply followed another, is not visible from outside. By the time a move appears on a public tracker, it has already happened. So whatever it was worth belonged to whoever caused it. Timing cuts both ways. Early numbers carry more error, which is where the opportunity sits, and more exposure to news nobody has seen yet. Later numbers carry less of both, and neither side of that trade is obviously right. Next, what a moving number can't show. Direction is not a verdict. A slide toward the underdog means money or opinion landed there, and on its own, that is all it means. Levitt went looking for skill among his 285 entrants and found none that persisted. Their season results scattered like independent coin tosses, and how well somebody had done up to a given week predicted nothing about the week that followed. Saying professionals are on a side is a claim about people whose repeatable success nobody could demonstrate in the one data set where both prices and quantities were visible. Most movement is also just small, and both samples say so. Levitt found the posted spread on Tuesday sitting within a point of the spread at kickoff in 90% of games, with the price changing an average of 1.4 times, and 85% of those changes being the minimum half point. Salkowski and Nelson found only 20% of their 2,560 games moving by more than a single point, and more than half moving by half a point or less. The eye is very good at finding patterns in that. Then there's the question of which line moved. Books don't post identical numbers, and they don't close at identical numbers. So the sentence about a line going from -3 to -4 quietly picks one book and calls it the market. Last, the evidence runs out. Levitt's NFL data stops in 2001, the basketball work in the 1990s, Salkowski and Nelson in 2011, the reverse line movement paper in 2016. Every one of those samples predates an era in which most bettors carry a sportsbook in their pocket, and nobody has published a satisfying update. Next, where that leaves the number. Levitt's constraint is the sentence to carry away from any page about line movement. Books shade prices about as far as they can without making a blanket policy of backing underdogs profitable. The number on the screen was set by people whose job is to leave nothing simple lying around, and watching it harder doesn't change that. A moving line reports what changed. It stays quiet about whether the new number is any better. That answer arrives from several hundred settled bets, and never from one afternoon in front of a screen. If this was useful, hit the like button and subscribe. The full analysis, with sources, is at LoserWins.com.